See whether you can see the slides. Slides are okay now?
Yes, I can see.
Okay, right. So we start. Right. This is the final module of our recovery, the Diploma and Credit Management Program. Final module is the recovery. When it's talking about recovery, what comes to our mind is recovery of default facilities, of course. So this is the most crucial part in our lending. We are happy about granting facilities, but when it comes to default, recovery is extremely difficult. Let us see why it is becoming difficult. What are the available resources available for a lender to go for recovery? Most of the instances when we talk about recovery, we have two options. One is most of the banks, so most of the lenders first is writing the customer to pay on no for such a date. Writing letters. The second option is going and telling that we are filing action if you are not paid. These both are not professional and not ethical. There are certain legal and ethical, banking ethics are there. What are the how to access to this type of actions? Let us see what is recovery management first and process of recovery management. What are the central bank directives given for our recovery, the banks, and what are the options available, what are the legal structure available for filing, go for filing. So this course, about 3 days, we are going to discuss about these three areas. First, we start with what is recovery management, why we should go for recovery, what is the impact on recovery for a banks. Deposits makes bank impossible. This is very happiest thing. Whenever bank we started, or bank or in financial institutions, we very happy to grant facilities. We go out of the way, we get the customers, try to disperse as early as possible. Right? So it makes our bread and butter, bank's profitability. Lending makes the bank profitable. Because that is all. We are doing, our business is financial intermediation. We are doing our business is, any lender, our business is financial intermediation. We collect deposits and lend to the needy. And we earn a profit from our earning. So therefore, lending makes banks profitable. But when it comes NPA, non-performing advances, makes the banking perishable. Make the banking perishable. It will bank survival threaten. Bank has solvency threat. Bank has to face a lot of severe difficulties to sustainability and continuity. When it comes to disposition, even the bankers are very, of course, very sometimes, I should not say rude, but we are trying to maximum possible try to recover whatever it is available with the customer. This was our policy. Okay, let's see how the loans are defined by the eminent bankers. Loss of asset due to non-payment. Loan is defined as loss of assets due to non-payment. Now, whose asset is this? Whose assets? These are our assets because the loans, whatever given receivables are appearing in our balance sheet at current assets. Current assets, we know that current assets are any business is a working capital. Current assets are any business, we discussed the earlier sessions, current assets are receivables. Debtors are our working capital. It should come back as working capital, then only we can continue the business. What will happen if you are not paid, defaulted? Our current assets are deteriorating, our working capital deteriorating, our day-to-day operations are getting difficult, deteriorating, and not like any business, banking side, we have a lot of other repercussions. When our assets are not paid, it has a twofold impact. Twofold impact in our financials. Number one, our P&L get deteriorated. Profit and loss account get deteriorated because no interest is coming to as income in the balance profit and loss account. No income is coming on as to the profit and loss account as income. Second impact is when it losses, the NPA increases, or NPA, when the low facilities transfer NPA, we have to make certain provisions. According to strategy and regulation, we discuss it later. Strategy and regulations, we had to make provisioning for our defaulted facilities, non-payment. When we make the provisioning, again we had to debit the profit and loss account. Again we can debit to the profit and loss account. What will happen? Our profit has been deteriorated due to these factors. When the one customer is defaulted, it has a twofold impact on our profit and loss account. That is one of the issues we are having. Hello? Excuse me. Hello? Hello? It has a twofold impact on our profit and loss account. What is the impact on our balance sheet? We discuss this is our assets. When it's non-payment, right? Our assets, there are two folds. Assets are getting deteriorated. One side, our current assets recoverable amount is increasing, but there's no recovery. So it's a non-performing assets. And the non-performance assets are not generating any income. One thing. Secondly, the banks or any financial institution, so no matter any business organization, one of the performance measuring, like measuring of the performance, one of the indicator is the ROA, return on assets. One of the indicators is ROA, return on assets. What will happen to ROA? When our
Sir, excuse me, Kavindra.
Yeah, okay.
Sir, මං හිතන්නේ හරි සර් මම කතා කරා මම මේකෙන් කතා කරනකොට මම ඩිස්කනෙක්ට් කරා අපි කොල්ල දැන් කොල්ල දියා
Yes, there is some technical problem. Anyway, they said they have corrected it. Today is the second day of this program. Under Module 1, we are discussing the Module 1 subjects under Module 1, principles of credit management, lending policies and best practices, guidelines for good lending. Good lending means, in other words, quality lending. So please make a note of it. Guide good lending or quality lending. Guidelines. What are the guidelines for quality lending? So in the past, when a customer comes and asks for a credit facility from a bank, the manager or the credit officer, their first question, what is the security you have or what is the collateral you have to offer for this credit facility? So it is based on the security. So that's what we call it traditional security-based lending. It was. But actually it should be skill-oriented cash flow-based lending. What does it mean? You must analyze and see after granting the facility whether this customer, the borrower, will generate sufficient cash, sufficient funds for him to repay this facility. So whether he will have sufficient cash flow for him to repay this facility. So we call it cash flow based lending. But you have to analyze and see. For you to analyze, you should be skill oriented. You should be skill oriented. So we call it skill oriented cash flow based lending. So we are now moving away from the traditional security based lending towards skill oriented cash flow based lending. But security is also important. You must get the sufficient security to cushion the risk if there is any. But the first thing you must see whether the customer, the borrower, will generate sufficient funds for him to repay this loan once you have granted this facility. So we call it skill-oriented cash flow-based lending. So in other words, it is two ways out lending. Two ways out lending. Primarily cash generation within the enterprise. You must ensure before granting the facility, there will be sufficient cash generation within the enterprise to pay back the loan. This is the first way out. But unfortunately, if anything happened, if the first way out is, if it failed, then it should be realization of the security. You have to realize it from the security. So we call it two-phase out lending. The first one, cash generation within the enterprise. If it failed, the second way, realization of the security. So mainly it should be skill oriented. So you must develop your skill to analyze. That's what this program will help you to develop your skill, to do your analysis. Okay, let us go. Lending principles and best practices. So for your quality lending or good lending, there are some characteristics. There are about 10 characteristics for quality or good lending. What are those characteristics? One is safety of the funds, then liquidity, then profitability, then spread of your portfolio. We call it balanced portfolio. Lending portfolio or credit portfolio, what you have granted, that we call it portfolio. So it should be a balanced portfolio. Then the purpose, then the end use, need-based finance, viability-based instead of security-based, then own stake, and finally, national priority. In a quality lending or good lending, these characteristics should be established. That lending should have these characteristics. One by one, let us see. Safety. Safety of the fund you have lent. It is a major concern for the banker. If you recover what you have granted only, you can continue this lending business. You can continue this, otherwise you cannot continue this lending business. So it is a major concern, safety of the funds, what you are lending. Ability of the banker to critically assess the borrower's capacity to repay the borrowed amounts together with the interest. This is, you should be skill oriented for this purpose. That is, ability of the banker, you to critically assess the borrower's capacity to repay the borrowed amounts together with the interest. You must establish it. Actually, in the present context, this factor is very important because there are problem credits. When we say problem credit, there are defaults. What you have granted, sometimes you cannot be recovered. So default. We call it problem credit. Because of this one, this reason, you must be very sure that what you are granting, you must recover, for which your analytical capacity, you must develop skill oriented. You need skill. Safety of the funds, the primary characteristic for a quality of good lending. Then the liquidity. The liquidity, that is, it is common to everyone, not only for the lending institution, credit institution, banks, everybody. You should be in a position, you must have sufficient cash to repay your short-term claims. If there are any short-term claims, you should be in a position to pay. That is liquidity. If there are any short-term claims on you, you should be in a position to repay that one. That is liquidity. If you lost your liquidity, your credibility will go for 6. If you lost your liquidity, your credibility will go for 6. That's what happened in many credit institutions. That has happened not only in Sri Lanka, globally. That is the main reason. Loss of liquidity lead to failure of the institution. So bankers' ability to get the advances liquidated expeditiously. So you are granting your advances, facilities, credit facilities. So you should be able to recover it. You should be able to recover it together with the interest. So bankers' ability to get the advances liquidated expeditiously, that is liquidity. So that is another important characteristic of quality lending. Really, the banks, we are doing financial intermediation. Borrow from the depositors. From the depositors, we are getting the deposit and pay as credit facilities to the borrowers. So when the customers, the depositors, when they come and ask from us for their deposit, so we must pay it immediately or at short notice. You have to pay it. That is your liquidity in the case of lending institution, credit institution. If you lost that one, what will happen? When you are granting the loan, you must recover it back. Then only you can give it to your depositors. If you are unable to recover from the borrowers, then you won't be able to pay your depositors. Your liquidity will be lost. So in the case of financial intermediation, customers' deposits should be paid immediately or at short notice, for which what you have granted as loan, you should be able to recover. Then only you can pay. So this is also very important in the present context because of problem credit. So there is another term, NPAs, non-performing advances, the problem loan. When you are unable to recover, that is considered as non-performing advances, problem loans. Because of this one, this aspect also very, very important, liquidity. So you must maintain. So for you to maintain the liquidity, that means when the depositors come and ask for their deposit, you should be able to pay it immediately or at short notice. For that purpose, what you have granted should be recovered in time. liquidity. Then the profitability. Yes, this is also very important because all business institutions, they are operating for the profit. It is a key element for any business, including banking, profitability. So for which you have to run the business profitably. So for which, what is important? Sound business decision. You must take sound business decision. That is effectiveness, making the correct decision, doing the right thing. Then for that purpose, you must have the cost of fund, but how much you are spending on getting the funds, cost of fund. Then the transaction cost in the credit transaction, what are the costs involved in the transaction cost and other related risks you must consider, and going on with the lending business, then only it will be profitable to the credit institution or the lending institution. Once again, it is the key element for any business, including banking. For that, sound business decision you must take. You must consider the cost of fund. You must consider the transaction cost in the lending. And other related risks you must consider, and you must do your business. Then only it will be profitable for your institution, credit institution. So now there is a question I generally ask. There are two aspects we have seen now. First, of course, safety, very good, yes. Then we have seen the liquidity and then the profitability. The liquidity and the profitability both are very important for any business concern. Both are important. Liquidity as well as the profitability, both are very important for any business concern. But my question is, which is more important, whether it is liquidity or the profitability? Whether anybody can answer this? Which one is more important, whether liquidity or profitability?
Liquidity.
Very good, very good. Yes, very good. Yes, liquidity. Liquidity is the important thing. Why liquidity is important? In the case of profitability, when you are starting a business, at the beginning you won't get profit. Sometimes it may go on, and after some time only you will get the profit. Even other organization also, sometimes it may run on loss. So it will affect. Lack of profitability affect the institution or the business concern on a long term. But when you lose your liquidity, what will happen? The creditors, so short-term creditors, when they come and ask for their fund, if you are unable to pay, then your liquidity is lost, your credibility is lost, then one person will come ask for his fund, you are unable to pay, the store is spread, then almost all others also will come, you won't be able to pay them. You lost your liquidity, then you have to close down the shop because your credibility is gone. So liquidity affects the business institution in short term. Profitability also will affect, that is in long term, but the liquidity affects the institution in short term. So liquidity, profitability, both are important for any business concern, but the liquidity is very, very crucial. That's what happened in most of the business institution in Sri Lanka, especially the credit institution. What happened to Pramuka Bank earlier? Yes, lost liquidity. Then gold, then the other group, yes, what happened to them? Loss of liquidity. Then the institution is closed. So really the liquidity is very, very important. Right. Then the spread. That is, in lending business, you must maintain the balanced portfolio. The balanced portfolio. What do you mean by balanced portfolio? Balanced credit portfolio. What is mean? You should not keep all eggs in one basket. You should not keep all your eggs in one basket. If anything happened to the basket, you lose all your eggs. So you must keep the eggs in different basket. So when this basket is affected, that eggs only goes. Others, you can have it. So similarly, in lending business also, you should not concentrate to one sector or industry or field. You should not concentrate your lending only to one sector or one type of industry or one type of field. You must maintain a balance. That's what we call it, balanced portfolio. You may grant for business concern, corporate business, medium and small scale businesses, SMEs, agriculture, livestock, import and export, tourism. These are different sectors. So you must maintain your balanced portfolio in these sectors. Housing loans, you must maintain. Consumer credit, yes. So should not concentrate to one sector or industry or field. We call it, you will learn later, concentration risk. The bank is facing, the lending institutions are facing many risks. So one of the risks is concentration risk. That is concentrating your lending to one sector or one field or one industry. That is concentration risk. No, you must maintain a balanced portfolio. And not only that one, strike a balance among short-term, medium-term, and long-term loans also. So your lending should be a balanced portfolio even in the prepayment period based. That is short-term loans, medium-term loans, long-term loan also you must maintain a balance. So in your lending business, you have to maintain balanced portfolio. This is another aspect for a quality lending or a good lending. Should not concentrate to one sector or industry or field. That is concentration risk. So you similarly strike a balance among the short-term, medium-term, and long-term loans as well. Balanced portfolio you have to maintain. Then the purpose of your credit. Lending for approved purposes. There are approved purposes. That is, what are they? For productive and consumption purposes mainly. Not for speculative purposes. What do you mean by speculative purposes? You are investing some money, you are not sure whether you will get it back or not. Whether it will go for loss or it will be profitable, you don't know. Without knowing, that is speculative purposes. Good example, gambling. Another example, racing. These are speculative purposes. So, if we grant facility for these purposes, maybe to a customer for him to go for gambling, he may come back empty-handed. He may lose everything. So he won't be able to repay the loan. So for the speculative purposes, no lending institution grant facilities. But there is one exception. The share trading. For the share trading, in the case of big customers, some banks provide credit facilities to the big customers. We call it, the name of that facility, margin trading. We call it margin trading. For the margin trading, that is for the customers to buy shares and sell, buying and selling shares. So customers will buy the shares when the prices are low and try to sell it when the prices are up. But sometimes they may lose there also, because sometimes they are buying at low rate. The price may go even lower than that. Margin trading. For that, the banks are granting facilities only in the case of big customers, because even they lost in this aspect, in this margin trading, they have other avenues of income for him to pay back the loan. So though they lose their money in the share trading, they have other avenues for them to repay. So for that type of customers, banks are granting these margin trading facilities. That is the only exception. Apart from that, no banks are granting facilities for speculative purposes. Now you understand the meaning of speculative purpose. Bank should formulate its lending policy in respect of purpose. Yes, we are going to discuss about this credit policy today. There, of course, we will be discussing this. Almost all banks will have their credit policy. In the credit policy, this purpose of granting facility also an important aspect will be considered. So the purpose of granting facility. The end use. Another one, end use. Bankers should ensure that the money lent has been used for the purpose for which it was granted. You are granting a loan and you must know for what purpose this customer is going to use this loan. You must know. Why? Because for that, based on the purpose only, you are working out whether the customer will be in a position to repay his loan, whether he will generate sufficient cash flow. The skill-oriented credit officer will analyze for what purpose this loan is granted. So from that, because of that purpose, whether the customer will get sufficient cash flow to repay this loan. If it is used for some other purpose, sometimes he won't be able to generate sufficient cash flow. So the credit officer, when he grants the loan, he should know for what purpose this loan is granted, and he must ensure whether this loan, the credit facility, is used for that particular purpose. So one example I generally see. A customer, husband and wife both are working, they are getting good salary, but they don't have a house. They are staying in a rented out house. Right. So they are applying for a loan of about 10 million rupees to purchase the house. Okay. Everything, customers, husband and wife's salaries are okay, repayment capacity, they are in good employment. Okay. Other things aspect analyzed, and credit officer is satisfied, and then they are granting the facility. Now they are staying in a rented out house for which they are paying the rent. And their children also, they are going to school, the school expenses, various expenses, everything is calculated, considered, and the loan is granted. Instead of purchasing the house, if the customer goes and purchase a BMW car, what will happen? The bank has granted the loan. Customer, instead of purchasing the house, he goes and purchases a BMW. So what will happen? They have to continue in the rented out house, for which they have to pay the rent. School going children, they have to spend the money. So their day-to-day expenses, they have to spend. And in addition, the car also, they have to maintain the fuel and other things, they have to spend money. Can they repay the loan? No. Can they go, India family go and live in that car? No. He won't be able to repay the loan. This loan will go as a NPA, non-performing advance. So because of that one, whenever you grant the loan, you must know for what purpose this loan is granted, and you must ensure that for that purpose, this fund is, the amount granted as credit facility is used for that particular purpose. But there is one exception. What is that? Personal loans. Actually, these personal loans actually started by the HSBC. So they put the advertisement. We grant the facility, you use it for any purpose. That was the, we grant the loan, you use it for any purpose. Then all other banks followed. First started by the HSBC, then NDB, DFCC, even Bank of Ceylon, they also started granting this loan, personal loan, with this marketing propaganda. We are granting this loan, you use it for any purpose. We call it personal loan. So how is it possible? These personal loans are purely for the salaried employees based on the salary. And the salary is coming to the bank, the customer's account. So the cash is coming. Based on that cash only, the loan is granted. So let them use it for any purpose. Because the repayment is purely from the salary of the customer. So this is the only exception. That is the personal loan. The customer can take the loan and use it for whether he can buy a motorcycle or any consumer durable like a fridge or anything, or even a car. Yes. So this is the end use. So the credit officer or the manager should know for what purpose the customer is asking for the facility, and he must ensure after granting the facility, that facility is used for the particular purpose. Need-based finance. Need-based finance. What is this? Banks should ascertain the credit need of the borrower and lend accordingly. Overfinancing and underfinancing both are bad. Yes, when the customer wants a facility, the banker should ascertain what is the actual credit need of that customer and lend accordingly. Overfinancing also bad. By if the customer's actual need is 2 million, if you grant 3 million, the other 1 million, the customer may go and spend on some other unproductive purposes, so he won't be able to repay his loan. On the other hand, if you are your finance is underfinancing, customer wants 3 million, you have granted him only 2 million, the customer won't be able to complete his project or the business. Complete it. So because of that one, the anticipated income he won't get, he won't be able to repay the loan. So because of that one, the bank manager or the credit officer really analyze what is the actual financial need of the customer, and he must grant the facility accordingly. So this is another aspect of quality lending, another characteristic of quality lending, need-based finance. Viability-oriented lending versus security-oriented lending. This, of course, at the beginning I have explained to you. Advances should be granted based on the profitability of the business and the credit worthiness of the customer, the repayment capacity of the customer. Security is only an insurance. It is only an in case if the project or the business is failed unexpectedly, then only you will go for the insurance. So you will go for the security. So it is an insurance. Security only acts as a psychological support to the banker and the pressure on the borrower. So the banker will be happy, yes, I have obtained a security. This is only a psychological support to the banker. He did the analysis and everything, and based on the repayment capacity only he is granting the facility, but at the same time he is taking a security, but it is a psychological support to the manager or the credit officer, because okay, I have done my analysis, but even if anything happened unexpectedly, there is a security, a psychological support. On the other hand, the customer, the borrower, I have given my valuable property as a security to the bank, I must redeem it. So I must somehow or other pay his loan and I must get my property back. So security only acts as a psychological support to the banker and pressure on the borrower. So that's what we call it, viability-oriented lending versus security-oriented lending. Own stake. Borrowers should have a reasonable financial contribution in the business or the venture. Yes. So bank should not grant entire 100% of the amount requested by the customer for his project. The customer also contributes certain percentage for his project or business or the venture. So if the bank if the project, the customer needs 5 million rupees to complete and start the business or the project or the venture. The bank can give only certain percentage. Generally, it is 75% or more. Sorry, 75% or less. The balance 25% should come from the customer himself for the project or the venture or the business. So that own stake also should be, customers' own stake also should be established. That should be there. Then only the customer will have interest in this business. It will think, I also put my money. I also put my 1 million rupees in this business. I must run the business satisfactorily and successfully and repay the loan. So the own stake from the customer or the borrower also another important aspect for a quality or good lending. Borrower should have a reasonable financial contribution. In the business or the venture, we call it equity contribution. Borrowers equity contribution. We call it borrowers. Generally, it is 25% of the cost of the project, total cost of the project or more should come from the borrower generally. Then the national priority. Priority sector lending, we call it. So what are the priority sectors? Agriculture in Sri Lanka, agriculture, industry, tourism, then fisheries, exports, housing. These are the priority sectors. So the bank should, out of their total lending, a certain percentage, they must lend to these priority sectors also. Pramukata Angsaval. Pramukata Angsaval. They must, out of their total loan portfolio, certain percentage they must grant for these priority sectors also. Now there is central bank instruction directives for these commercial banks. There, out of their lending, certain percentage should go for housing, for agriculture, for industry, like that. Central bank directives is there. Even not only in Sri Lanka, even in USA, America, this priority sector lending is there. For housing, all banks has to contribute, lend at least certain percentage for the housing development in America. Capitalist, such a capitalist country. In India also, there is, out of all the banks, out of their lending portfolio, certain percentage should be granted for their priority sector. In Sri Lanka also, but initially the state-owned bank, Bank and People's Bank, they were granting loan for these priority sectors without any pressure from outside. But now the central bank has directive to all the banks to set aside certain percentage of their lending for these priority sectors. So these are. So all these are the important thing, characteristic for a quality or good lending. The most important is recovery, safety of the funds, liquidity, profitability. These are the most important one. But all other, out of all 10, there are all 10 characteristics are important for quality or good lending. Now we move on to lending proposition. So lending proposition, from where it should come, the specific lending or borrowing proposition should come from the customer. It should come from the customer. The bank manager or the credits officer should force the customer to take this loan. Actually, in the bank, there are targets for certain loan products or saving product. Banks, their hierarchy gives the targets to the branches. To achieve their targets, they should not force the customer, take this loan, no. Under relationship banking, I have told you, I have explained. That is, I have explained cross-selling. Cross-selling. When the customer comes for certain purposes, you establish a very good relationship with that customer. You call him and sit and you can talk to him and you can tell him what are the facilities you have. We have these facilities for these purposes, these loan products we have, these saving products we have. You can explain. That is marketing and cross-selling. That you have to do. Marketing, cross-selling. When the customer is coming for one purpose and the other things also, you are explaining. But you should not force the customer, take this loan for you to achieve your target. No. So, but the specific lending or borrowing proposition should come from the customer himself. He only knows what is his request, what he wants. Sometimes he wants a housing loan. He may be living in a rented out house. He may need a house. So housing loan. So he may be doing a business. He needs some working capital finance, transfer of working capital. He may need a working. He only knows what is he really, but you can advise him. So when a customer wants to borrow, the banker must reach a decision about whether to respond favorably or not. Okay. So when the customer come and ask for a facility, you have to make a quick decision whether favorably or not in favor. Respond. How to respond? So your response will be the banker should decide whether the proposition is acceptable as it is. The customer wants a working capital loan. He is running a good business. Working capital loan of 1 million. So when you do the analysis, yes, he needs 1 million. So you can accept as it is. Acceptable with some changes. He is asking 1 million working capital loan. When you do the analysis, 1 million is more. So if you grant over financing, that amount it may be over financing, customer may find difficult to repay the loan. He can manage his working capital with another additional 800,000 rupees. So you acceptable with some changes. You can tell the customer 1 million අවශ්‍යතාවයක් නෑ මහත්මයාගේ analysis අනුව මහත්මයාට 800,000 ඇති. ඒ නිසා 800,000 අපිට පුළුවන් දෙන්න. So bankers should decide whether the proposition is acceptable as it is or acceptable with some changes or not acceptable. Sometimes, yes, it won't be acceptable because the customer may be not credit worthy, customer's repayment capacity, if we grant that facility, is not sufficient enough. So the loan may go for NPA, problem credit. So because of that one, not acceptable. But you have to make a quick decision. The banker should decide whether the proposition is acceptable as it is, or acceptable with some changes, or not acceptable. So this is the lending proposition. You should not force the customer to take the credit facility. On the other hand, the borrowing proposition from the customer. The customer must make clear to the banks when the customer wants a facility. He must make it very clear to the bank manager what is the amount he needs, for what purpose he needs, how is the repayment period, within what period he can repay this loan, what is the source of income for him to repay this loan. So these 4 aspects, the customer should make it very clear to the manager of the bank or the credit officer. But the bank officer, he will do his analysis and see whether these are acceptable, whether the amount is acceptable, whether the purpose for which he is asking the facility is acceptable, whether the repayment period he says whether it is acceptable, or it should be short, or it may be more. Source of income, yes, he analyzes. But the customer make clear to the banker. Otherwise, banker, these aspects very clearly the customer must tell. So you must really educate your customer to come when he wants the facility. He must come with these answers. So this is borrowing proposition. The borrower should make it very clear to the bank what he really needs. Banker's responsibility. Bank is doing a business. Yes, we are doing business. It should sustain its business operation. So the bank should continue this business operation, for which what they lend should be recovered. Then only it can go on, sustain the business. bank should safeguard its funds and make a reasonable profit to sustain its lending operation. The safety of the funds, quality lending, the first aspect I have already explained, told you. So the bank should safeguard its fund and make a reasonable profit to sustain the business operation. So you must run the business with a profit, On the other hand, if it runs the business with a loss, then in the long run, it will be a failure. The banker, to ensure as far as possible that the borrower will repay the debt in full with interest within the scheduled time. So when the facility is granted, the banker should satisfy himself. He must ensure I have done all the necessary analysis and everything, and I am satisfied with this borrower. He has the repayment capacity, so I have given this loan facility to him. Definitely, he will repay this loan. So, the banker, to ensure as far as possible that the borrower will repay the debt in full with interest within the scheduled time. He must ensure. The banker, the credit officer should ensure. Banker's decision on lending. So, for him to ensure the correct decision making by the banker is important. So, banker's decision on lending. What is it? Bankers reach lending decision very often based on experience. Certain feeling that the loan will be repaid in full. We call it intuition. Bankers do the whole analysis and everything in regard to repayment capacity, credit worthiness of the customer. But as they say, that is based on the experience. So the bankers, when he making a decision, there's an intuition. There is an intuition inside, inner feeling. Sometimes we call it gut feeling, intuition, inner feeling. I have done all these analysis, everything. I am granting this loan. This loan will be repaid. So he will have the intuition. But sometimes some managers, maybe during our days, I have heard some managers used to say, maybe in your case also, some managers may be saying like that. Muge moona balna kotama mu gewanna naha. E nisa muta mama naha denna kiyala kiyano. Sometimes manager. Yage moona vediyata tibunata, how the manager knows he won't be repaying the loan without doing the proper. Just looking at the face, some managers making the decision. Just looking at the face. But it should not be. But the experience should come from learning and applying the principle of good lending thoroughly. The managers, credit officers must develop their experience moona balala navi. Not by looking at the face. How it should come, experience should come from learning and applying the principle of good lending thoroughly. Maybe a credit officer, now he is appointed as a credit officer, the first loan facility file is given to him for him to do the analysis and recommend whether to grant or not. Maybe he has to do a thorough check. It may take about maybe 1 or 2 months. Yes, because this is the first file, credit file he is handling. So he is going through all these things and yes, and making his decision. That is first loan. Now he has some experience. The second file, credit file is given to him. First file, it may took about 2 months. The second file, yeah, he can do it in 1 month. He has some experience. Third credit file, he may do it in 3 weeks. Fourth credit file, he may do it in 2 weeks. Next credit file, he may do it 1 week. And then thereafter, the credit files, the way customer comes and sit in front of him, the way customer answers question, based on that one, then and there, the credit officer or the manager can make a decision. That is intuition, inner feeling. So the experience should come from learning and applying the principles of good lending thoroughly. All credit officers, good credit officers have developed their experience through this way. Learning, and applying the principle of good lending. Thereby they get, not like moona balala nabi. So keep it in your mind. Bankers' decision on lending. Okay, so basic things about lending, how the lending officer, credit officer, the credit managers have to perform in their lending operation, we have discussed. Now we move on to another important thing, culture, Sanskriti. Culture. What do you mean by culture? This is the sum of attitudes of people, ideas of people, customs of people, beliefs of people, values and social behavior of people, particular people, or society that distinguishes us from the others. So one society will have, that society or one group of people will have what? Their attitudes, their ideas, their customs, their beliefs, values, social behavior. A group of people or society of people will have. So that differ from the another group of people, differ from the another society. So this is culture. You can see Sri Lankan culture. All Sri Lankan will have a common culture. This culture will differ from Indian culture. There may be some similarities, but there are differences also. These both cultures differ from Western culture. There may be some similarity, but there are differences also, etc. So these are culture, Sri Lankan culture, Indian culture, Western culture, like that. It will go on. European culture, English culture, it goes on like that. Now this culture, it is transmitted from one generation to other through languages, materials, rituals, arts, etc. From one generation, it passes on to the next generation. From this generation, it's passed on to the... So this is the culture is passing from one generation of group of people or a society from one generation to another through languages, materials, rituals, etc. So one good example in Sri Lankan culture, the children will generally children respect their parents and other elders. They worship their parents, and this culture is continuing. It is there. This is one of the culture. So similarly, there are so many things. Even marriages. There's culture. Customs are maintained. So this is from one generation, it goes on. So this is culture. Then within the culture, main culture, within the culture, there are subcultures, main cultures and subcultures. Now Sri Lankan culture is the main culture. Within this main culture, there are subcultures. Buddhist culture, Hindu culture, Christian culture, Islamic culture. These are subcultures. They have the common aspects, and certain things, their culture differ also. All these cultures, Buddhist culture, Hindu culture, then Christianity culture, Islamic culture, there are common aspects also. But there are differences also. So all our main culture, Sri Lankan culture, within that one, there are subcultures, main cultures and subcultures. This is in regard to society, group of people. Then, within this main culture, there are organizations. The organization also will have their own culture. Now, if you take a big organization like John Keel's, it's a big organization, corporate. So the people who are working there will have their culture. That is, their attitude, ideas, custom, beliefs, values, social behavior, etc. They have their culture. John Keel's. Similarly, the Maharaja organization also will have their own culture. There may be common thing and there may be differences also between the culture of John Keys as well as culture of Maharaja organization. Like that, yes. So organization culture, within the main culture, Sri Lankan culture, each organization also will have their cultures. We call it organizational culture. This organizational culture also we can divide into two: strong culture and the weak culture. Some cultures, some organization culture, this comes from the top to bottom. It is developed by top and it comes down, yes. And all the people working in that organization, they know what are their culture and they adhere to those culture. That is called as strong culture. Some organization, there is no culture development. Sometimes the culture may go from bottom up, from the bottom line, so it may go up. Actually, it should come from top to bottom. So that they are, of course, the weak culture, because almost all the people working in the organization, they do know what is their behavior, what is their attitude, what is their idea. Different people have different things. So they don't have a strong organizational culture. That is a weak organizational culture. Actually, this organizational culture in an organization developed from what? Now, when you take all organizations, they have their vision, they have their mission, and they have their values. What they respect mostly, that is the values. The vision is what do they want to achieve of that organization. The mission is how do they want to achieve that vision. That is vision and mission. And then values. The values are what are the aspects they give more important. That is the values. So if the values are known to the workers or the participants in that organization, they know these are our values. We must adhere to it. Then it will have, so this culture developing from the values. So when everybody in that organization know their values and they develop their culture, it will be a strong culture. Generally, it is a top-down culture. When the people in that organization, they do not know, they are not aware, only a small group of people know their values, then they won't adhere to it. And mostly sometimes it won't be a top-down. If it is top-down, they actually from the top to bottom it will come. So it may be a weak culture. The organization with a strong culture work very efficiently and effectively. The organization with weak culture, they are weak in effectiveness as well as in efficiency. So the strong culture organization perform well. Weak culture organization perform poorly. So this is generally the culture. We understand the culture, meaning of culture. Then in a country, the main culture and the subculture. And in the country, the organizations also will have their culture. There is strong culture, weak culture. Now, credit culture. This is also come as a part of the culture. Credit culture. What is this? Credit culture. Credit culture. A bank's credit culture is the unique combination of policies, practices, experience, and management attitudes that defines the lending environment and determines lending behavior acceptable to the bank. It is a lending behavior based on policies, practices, experience, management attitudes, etc., etc. So that decides the lending behavior of that credit institution, of that bank. Then that is acceptable to the bank. So more broadly, credit culture is the system of behavior, beliefs, philosophy, thought, style, and expression relating to the management of the credit function by the employees of the credit organization, by the employees. So this is an important thing. So in a credit institution, a bank or a finance company, the employees should know their values. And apart from that, another important thing, credit policy, which we are going to discuss. Today, we will be discussing about the credit policy. The employees who are doing this credit function should know their values, should know their credit policies. Then they also will have a strong credit culture and they can perform well. If the employees of the credit institution who are doing credit function, if they are unaware of their values, and if they do not know about their credit policy, they won't be able to perform. They will have a poor credit culture, very weak credit culture. They won't be able to perform well. So in the case of credit institutions, also there are strong culture institutions, there are weak culture institutions based on what I have told you, based on their employees who are doing this credit function, their knowledge about their values and their knowledge about their credit policy, depending on that one. And another important thing, you would have heard, you may be discussing it later, Basel. Basel is a concept. There was Basel 1, Basel 2, now it is Basel 3. From Basel 2, this importance of the credit culture is emphasized for a bank, for a lending institution to be strong and perform well and to reduce their NPAs and to avoid their failure, the bank failure. Those banks have to maintain a strong credit culture. The bank has to maintain a strong credit culture. From this Basel 2, it is emphasized. We will discuss about the Basel. If you don't know, don't worry. Yeah, this is another important aspect. There will be another separate lecture by this Basel. So it starts from Basel 1, Basel 2, now it is Basel 3 also. So this credit culture. So it is a word of advice to you all. Please try to understand the values. Where can you find your values? Actually, if you go through your annual report, bank's annual report, from the first page itself, the vision of the institution, what do they want to achieve, then the mission of the institution, how do they want to achieve, then values, what we value. Those things are there, the values of the institution and the credit policy of the institution. These are very important. Then if you all know all these aspects, then your institution also will be a strong credit culture institution. Credit policy and credit policy document. Yes, now we have come to credit policy. Credit policy. All lending institutions should have their credit policy. It establishes guidelines and principles for an credit institution, credit risk strategies and policies. It aims to achieve a consistent, sound credit portfolio in the entire institution. The entire institution. Now, almost all credit institutions, they have their branches all over Sri Lanka. So, everywhere, a consistent, sound credit portfolio in the entire institution. For that one, they must have a suitable credit policy. And apart from that, desired credit growth while managing the risk. So, when you are granting the credit facilities, you have to face some credit risk. Credit risk is there. That also we will be discussing today about the credit risk. So, you must achieve the desired credit growth, maybe 5% credit growth or 10% credit growth, like that, by managing the risk related to credit. Credit related risk. Managing that one, you want to achieve certain credit growth. So for this purpose, the credit policy is very, very important. So the credit policy, once again, aims to achieve a consistent sound credit portfolio in the NDA institutions. Consistent sound credit portfolio with very low level of NPAs. Actually, you can't completely wipe out the NPAs. There will be, but the percentage of NPA may be point something NPAs or problem credit or the credit default. So a consistent sound credit portfolio in the NDA institution and the desired credit growth while managing the risk. This is the credit policy. For that, the credit policy is important. Credit policy. One institution is different from the other. So the policy also different. Really, one institution, one credit institution different from the others. Obviously. So their credit policy also different. Now, finance companies, they may have their credit policy based on their function. Then small banks, there are small banks, they also have their credit policies for their credit function. Development banks, their main target is developing lending, development lending, developing purposes. They also will have their credit policy that is related to development lending. And large banks, commercial banks, with all type of customers, they are catering all type of customers, corporate customers, middle market customers, small customers, SME customers, farmers, industrial, yes. So they also have the credit policy based on their customers, yes, based on their purpose. All credit policies aims, whatever it is, whether it is a finance company or a small bank or a development bank or a large scale commercial bank, all credit policies aim sound credit portfolio without any NPAs. Sound credit portfolio without any or very low level of NPAs. That is the purpose of credit policy, having a credit policy for the credit institution. Credit policy document and its preparation. So the credit policy is in a document. It will be in a document. How it is prepared? First we look at that one. So the credit policy in a document, how it is prepared. Written document for uniformity. So the bank, for the uniformity within the NDA institution, within the NDA credit institution, written document for uniformity. Senior officers of the institution with extensive experience in credit management, they discuss, prepare the credit policy, and then circulate among other senior officers for them to go through and make suggestions or recommendations. And if there are suggestions and recommendations, amend. If necessary, it will be amended. And then finalized. The credit policy document, then the credit policy document will be finalized. Now we know how it is prepared. So it should be approved by the CEO, GMO, and the board of directors, the hierarchy, top hierarchy. Board of directors, CEO, or the GM. So it will go through CEO, the GM, and then finally to the board of directors. It will be approved. So this way it is prepared and approved, the credit policy within a credit institution. It should be flexible, updated periodically based on changes taken place through internal circulars. Right now, so it is not a once and only document. No, it may be, there will be changes. There will be political changes, there will be economic changes, there will be locally or globally changes. So based on that one, it will be amended. It will be amended. So it should be flexible. Flexible will be, yes, whenever necessary, it should be amended. So it will be flexible and updated periodically based on changes based on changes taken place through, and it will be updated through internal circulars. So from the head office, the internal circulars will be sent to all branches, departments, and within the organization in all places. We call it office instruction circulars or internal circulars or circular letters. There are various names used by various institutions. Through those documents, it will be amended or updated. So what are the changes? Local and international regulations may change. Especially the Central Bank of Sri Lanka, they may regulate. They are the regulators of the lending institution, credit institution. So they may, from time to time, they may update. So based on that, no international regulations which we are following. Then the economic situation. So when the economic situation changes, yes. Similarly, the political environment may change. So accordingly, the credit policy also will be updated or amended. Then the risk appetite of the credit institution. Now, risk appetite, yes. So some institution will try to, they are willing to take risk. Some institution, they are very careful. They don't want to take much risk. So that type of institution, when they want to get more risk, they are going to face more risk, then of course they may change it. Based on the risk appetite of the institution, the credit policy may get changed. Then the competition. Among the credit institutions, banks and finance companies, there will be always competition. So based on the competition, yes, some institutions want to go for yes, more competition, okay, they may change their credit policy based on that. So these are the things based. So the credit policy document, how it is prepared, and it is not rigid, it should be flexible and updated periodically based on certain changes that we have discussed. Then the credit policies must be subject to directions of the Banking Act. Yes, Banking Act. Then in the case of Finance Company, Finance Act, and all 11 regulations. So these credit policies should consider all these aspects, especially the Banking Act, Finance Act, and all 11 regulations should be considered when preparing the credit policy. The direction issued by the CBSL and international norms are essential guidelines in formulating credit policy. Then again, international guidelines plus the CBSL directions. CBSL, Central Bank of Sri Lanka, periodically is in the directions to the commercial banks and other banks, finance companies. Then the financial institution may decide the maximum size of its loan portfolio based on a deposit base, capital base, and other factors. So now, what is the maximum amount of loan portfolio a credit institution, a bank can go for? What is the maximum amount of total loan portfolio? That depend on deposit base, how much deposit they have, and how is their capital base based on that one. So this is actually discussed by another lecturer based on that. Basel, here is Basel, based on the Basel only, this direction. The regulator of the banks in Sri Lanka, CBSL, Central Bank of Sri Lanka, advise all the banks and finance companies, all these people. So based on that one. So there will be another separate lecture in detail about this aspect, about what is the maximum size of the total loan portfolio based on deposit based and the other factors, capital based and other factors. Then, yeah, this is the basic credit policy. Organization chart for the credit function. So within the organization, the credit function will be performed from the top and down bottom, the hierarchical order, it is performed the credit function. So what is the organization chart for this credit function? Credit policy document will outline the organization chart 11 for the credit institution. So in the credit policy document itself, the organization chart will be mentioned. Credit policy document will outline the organization chart 11 for the credit function. So what is the organization chart? That will be mentioned in the credit policy. The board of directors is the highest authority. Board of directors, higher authority, followed by board of credit committee, there is a credit committee. All credit institutions will have, we call it board of credit committee. Then the CEO or the general manager. Then the DGM credit. From there it is AGM. And then the regional managers, provincial managers, area managers, and branch managers. It comes down from top to the bottom. It comes down the organization chart for the credit function. It will be mentioned in the credit policy document. The functions and responsibilities of these officers will be clearly described in the document. So only the organization chart and the functions and responsibilities of the officers in this credit hierarchical line management, it will be mentioned. What are their functions and responsibility of these officers will be clearly described in the document, credit policy document. Then another aspect, delegation of authority. So people in the hierarchical, the top people, they will delegate some of their authority to the people in the bottom line. That is delegation of authority. Each person involved in lending should know his or her authority limit to approve credit within the institution. So in the credit hierarchical order, each person will have a credit function we have seen. So what is the maximum amount they can approve? Each person involved in lending should know his her authority limit to approve credit within the institution. This authority is delegated according to a person's position within the organizational hierarchy. Obviously, board of directors will have the highest approving the amount. Then a certain amount is delegated to the GM or the CEO. Certain limit is delegated to the DGM credit. Certain limit is delegated to the AGMs. Certain limit is delegated to the other officers down the line. So this authority is delegated according to person position within the organizational hierarchy. The credit policy document indicates authority of the board of directors, authority delegated to the board of credit committee, CEO or GM and other officers in the credit approving hierarchy. So it is mentioned in the credit policy document. And these amounts so delegated are reviewed annually. Yes, and it will be reviewed annually. Sometimes based on the officer's performance, it may be increased, authority level may increase. In some cases, it may be reduced also, based on the person performance. So it is anyway, it is reviewed annually. The delegated authority limit will be delegated and reviewed annually. Delegation of authority. The GM or CEO of the institution will issue letters to individuals of their credit authority limit based on position, experience, and credit knowledge. Yes, after approving the authority limit, then they will be informed through letters. The delegated authority limit will be informed to the respective officers through letters. Who will do it? GM or the CEO of the institution will issue letters to individuals of their credit authority limits based on the position, experience, and credit knowledge, etc. Consequence of violation of delegated authority limits are described in the document. Sometimes an officer has a limit of maybe 5 million rupees credit facility. If he approves 8 million rupees credit facility without the hierarchies, without his concern, if he himself approves, his limit is, authority limit is, delegated authority limit is 5 million, but he approves and grant 8 million. What is consequence of violation of delegated authority limit? So this deliberate violation of this authority will lead to disciplinary action. There will be disciplinary action against that. Not only this one, in some cases, prohibited credit. So there are certain credit, of course, for certain customers, credit facilities cannot be granted. If the facility is granted to that customers, that also deliberate action of that officer concerned. So this there will be disciplinary action will be taken against that officer. Procedure to be followed in exercising the authority, exceeding authorities, in case of emergency, obtaining covering approval are also included in the sometime. Now, branch manager is there. There is a good customer coming for a maybe OD facility, overdraft facility, maybe of course about 2 million. But the branch manager's authority is only 1 million. So actually, what he has to do, he has to prepare the document, prepare the papers, and send to the higher approving authority, maybe the AGM. He may have to approve this 2 million credit overdraft facility, but unfortunately, he is not there in the office today on the particular day. Anyway, he is talking to his over the telephone. It is concerned. Okay, he explained about this particular customer, why it is urgent. And then, of course, he says, okay, you go ahead. I will come and approve. Then this branch manager will grant a facility and send the papers to the AGM for his covering approval. We call it covering approval. Already facility is granted, but now obtaining a covering approval for the facility already granted. So procedure to be followed in exercising the authority, exceeding the authority in case of emergency, and obtaining covering approval are also included in the credit policy document. So these details also are included in the credit policy document. Delegation of authority linked to collateral. Yes, what is the type of collateral you are taking? So the linked to collateral also there is delegation of authority. Certain for collateral, what is the amount you can give? What is the maximum amount you can grant for in related to a particular collateral? But one thing the credit officer has to do, whether the customer has the repayment, just not only on security. He must do analysis and see he has the repayment capacity, but he is taking a collateral to cushion the risk if there is any. So for that particular security, what is the amount? Delegation authority linked to collateral also there. Authority to allow credit without collateral also included in the document, that is TOD, temporary overdraft, that is without the security. The TOD is a credit facility granted without any security, without any collateral, So authority to grant that type of facility, that is without any collateral, that also given, that instruction also given in the credit policy document. Authority to allow credit without collateral also included in the document. Example, TODs. How to grant the TODs? That is there in the credit policy document. Then the pricing policy in lending. The pricing means in lending, what are the charges you are charging for the particular credit facility? That is lending interest rate and maybe other service charges, commissions, etc., etc. The lending institution should maintain a uniform pricing policy for lending to various customer segments in the entire institution. So, lending institution grant various customers, various type of customers, and in all over all the branches. So, the lending institution should maintain a uniform pricing, whether the facility is granted in Colombo or in Kandy or in Hambantota. Yes, a lending institution should maintain a uniform pricing policy, that is lending interest rate and other charges for lending to various customer segments in the India institution, considering its cost of fund, administration cost, and other risk factors. These are the major thing. Cost of fund they must consider, then administration cost in related to lending, and the risk factors considered. So a uniform pricing policy in lending to various customer sector in the entire institution. Fixed rates or variable rates. Now, of course, earlier we were having fixed rate. Once the facility is granted at a particular interest rate, a lending interest rate, then that interest rate will continue till the facility is repaid. But now it is not so. Now it is flexible. Now it is, what is it? Variable rate or floating rate, we call it. So fixed rate or variable rate, the types of credit, type of facilities subjected to those rates are also included in the credit policy document. So about this fixed rate or variable rate, type of facilities, those information also given in the credit policy document. Then pricing can be linked to prime rates. In the case of certain best customers, the pricing, that is lending interest rate, can be linked to prime rates. What is the prime rate? One is AWDR, average weighted deposit rate. Other one, AWPLR, average weighted lending interest rate. Average weighted lending rate. Prime lending rate. So these are prime rates. One is AWDR, average weighted deposit rate. Other one is average weighted prime lending rate. Or treasury bill. Treasury bill rates also considered. Now, this AWDR or AWPLR, actually, it is announced by the central bank. They collect the commercial banks, their deposit rates, how much they pay for the deposit rate, or the lending, in the case of lending, how much they charge for various type of credit facilities. They collect this information from all commercial bank. They analyze and take an average weighted rate and published in the papers. And they published in the papers. Every Monday you can see this average weighted, these prime rates they publish. We call it prime rates. So there are two types of prime rates. One is average weighted deposit rate, that is in regard to deposit, and other one average weighted prime lending rate, that is in regard to lending. They publish. So the commercial banks also can lend. They charge their interest rate on lending linked to these prime rates. They may say maybe 2% above the average weighted prime lending rate, or maybe about 4% above the average weighted deposit rate to their best customers they may offer. To keep the customer with them, yes, they negotiate and they offer. So pricing can be linked to prime rate, that is AWDR or AWPLR, or the treasury bill rate are also included in the document. So that also included in the credit policy document. For what type of customer you can offer these rates and everything, how to link, all this information is there in the credit policy document. Pricing policy is clearly stated when the credit facilities are considered against the borrower's deposit with the institution. Sometimes the borrowers may have their deposit, maybe 1 million, 2 million deposit with the bank, and they want a credit facility against that deposit. So how to charge? That instruction also given in the credit policy document. Maybe 1% above the deposit rate the customer has with the bank charge, or 1.5%, that differ. That also will be updated periodically, but that is there. So pricing policy is clearly stated when the credit facilities are considered against the borrower's deposit with the institution. This is pricing policy in lending. Is there pricing policy mean lending interest rate, other commission, charges, etc., etc. Then the portfolio mix. This is portfolio. What are the different type of credit facilities, different sectors? An institution's loan portfolio can be mixed of all sectors, or it can limit the sector it can advance within it. Some in credit institution it is really concentrating. Yeah, concentrating certain. If you take Indian banks branches in Sri Lanka, they are mainly concentrating on import-export, mainly import-export sector. If you take HSBC or like the foreign bank branches, mainly the personal loans like that, and the credit card business like that. Standard Chartered, yes, like that. Mainly the personal loans and credit card businesses like that. An institution loan portfolio can be a mix of all sectors, or it can limit the sectors it can advance within it. To maintain a balanced loan portfolio, it can decide the amounts to be advanced to each sector. What is the total amount advanced to each sector? In deciding the sector exposure, institution will consider regulatory guideline, that is central bank outline. They are saying here for housing you must give, for agriculture you must give, for industry you must give, allocate this percentage. So you must consider those regulatory guidelines. Then the priorities, the institutional priorities. What are the sectors the institution may like to give grant more? Political authorities, based on the political. Now, the government may say, give more loan for the agriculture, give more loan for the SMEs. Yes. Then geographical location of the institution. In the branches in the rural area, district mostly in cultivation, mostly in agriculture. Or similarly, the coastal area maybe with other purposes, maybe for fisheries. Like that, geographical location of the institution. The institution, the branches in the township areas, maybe for the trading, maybe for personal loans, employees. So, in deciding the sectoral exposure, institution will consider regulatory guidelines from the central bank, then priorities of its own priorities, then political authorities, what the government says, and the geographical location of the institution. This will govern the portfolio mix. Portfolio mix. Now, balanced portfolio mix is a tool to mitigate credit risk. Yeah. When you concentrate in one sector, like keeping all eggs in one basket. If the basket breaks, all eggs will break. So mitigate the credit risk, you must maintain a balanced portfolio. Do not keep all eggs in one basket. You have to maintain a balance. So major sectors considered in credit policy are commercial, financial. Yes, what do you mean by financial? Even finance companies may borrow from the commercial bank, financial sectors. So commercial bank may advance those various finance companies also, financial. Then agriculture, tourism, industrial and other manufacturing, housing, SMEs, consumption, and maybe there are other other sectors, other areas, others. So this is a portfolio mix. So maintain a balanced portfolio. So that is also there in the credit policy document. Then the customer and the market segment. Customer and market segment, that details also will be there in the document will define the bank's market segment and create criteria for such segmentation. So any business organization, we should have segmentation. So based on the segment, they must develop strategies to do the business. So it is, banks are not an exception. Bank also should have their segmentation, customer segmentation or market segmentation. Market segmentation. So the document will define the bank's market segments and criteria for such segmentation. Corporate customers, then middle market customers, and then the retail customers. These are some examples. Criteria may be annual turnover, total asset, or number of employees. So they categorize this market segment based on their turnover, annual turnover. How much annually their turnover. Based on that one, they may business customers, they may segment to corporate, middle market, and retail customers. Our total asset, how much their total asset. Based on that one, they segment that customers, corporate, middle market, or retail customers. Or number of employees employed by the institution. So mainly based on these things, they will segment their customers, customer segmentation or market segmentation in regard to business customers. Different policy framework can be used for different segments. So different segments, so you may have different policy for this different segment. Different policy framework can be used for different segments. For corporate customers, you may have a policy segment, policy framework, how to lend. For middle market, you may have a policy framework, how to lend. And the retail customers, how to lend. Different policy framework can be used for different segments. The evaluation process, how you are evaluating those customers, method of pricing, how much interest you are charging for them, and collateral requirement also will be included for these customer segment in the credit policy document. So in the case of corporate customers, how you are going to charge them? What is the lending interest rate? How you will? What are the securities you are or collateral you are obtaining? How you will evaluate them? It is there. In the case of middle market customers, how? What is the lending interest rate? How you are going to evaluate them? What are the collateral you are going to take? Yes. Similarly, the retail customers. All these informations are there in the credit policy document. Then there is prohibited or discouraged credit facilities. An institution does not entertain certain type of credit facilities for various reasons. And that also included in the credit policy. So credit institution, they don't entertain certain type of credit facilities made requested by the customers. What? For the legal, cultural, religious reasons. Yeah. There are because of legal reason, they don't grant those facilities. Maybe for the cultural reason, they won't grant. Maybe for religious reason, they won't grant. Then advances for illegal purposes. Illegal purposes. Legally banned. No. Then manufacture and trading of narcotics or firearms. No. So these are main legal or cultural or religious reasons. Some credit institutions, they won't grant facilities for those reasons. Some credit institutions, they are not granting facilities to establish slaughtering plants, meat processing plants, poultry slaughtering or cattle slaughtering. Cattle slaughtering Indian banned. Female cattle, yeah. So that is for maybe for the legal or cultural or religious purposes. Some institutions they don't consider. For illegal purposes, alcohol, brewing alcohol, or gambling. But gambling, of course, you can see there are big organizations. Yes, anyway. Yeah, but legal, cultural, religious reason, some institutions they won't grant any facilities. Advances for illegal purposes. Then manufacture and trading of narcotics or firearms. Borrowers and guarantors listed as defaulters in CRIP reports also come under this category. CRIP report, Credit Information Bureau. Actually, before granting the facility, we will get a CRIP report in respect of the borrower and the guarantor from the Credit Information Bureau. We call it CRIP. There, the customer's credit history will be there. We will learn about detail in maybe I will be discussing maybe in my next lectures. So CRIP report, if you know, there is a report we call from the Credit Information Bureau before granting a facility to a borrower or a guarantor. If they are listed, borrowers and guarantors listed as defaulters in the CRIP report also come under this category. So generally we don't grant any facilities to the borrowers or guarantors who are listed in the as defaulters in the CRIP report. And the procedure to be followed in this situation also included in the credit facility. But if the customers are good on it, if you want to go ahead, but what are the things you have to follow? What are the things you have to follow if you want to grant any facility to this type of customers? That details also they are in the credit policy document. Application of borrowers who do not provide required information as per bank's policy will be rejected. Application of borrowers who do not provide required information as per bank policy will be rejected. Minors and persons with unsound mind will also be in this category, and the procedures to be followed are included in the policy document. So minors and persons with unsound mind, that also coming under this category, that is prohibited or discourage credit facilities. Then about the collateral and the documentation, credit documentation or loan documentation. That details also they are in there. So everything in regard to this credit is there in the credit policy document of the respective institution, credit institution. Each type of credit facility and the collateral acceptable to the institution for such credit facilities and the procedures to be followed in each category are included in the credit policy document. Purpose of granting short-term and term loans are also explained to safeguard the lenders' interest, and to ensure enforceability of collateral in case of. So each type of credit facility and the collateral acceptable also mentioned. Generally, medium-term facilities related to the medium-term collateral. Long-term facility related to long-term. Actually, in Indonesia, what happened? Indonesia borrowed from international organization. In the short-term borrowing, payable in short-term, and lend to long-term purposes, construction of buildings. So when they have to pay the people, the institution which are granted loans to this Indonesian bank, they couldn't, because they have granted for the long-term purposes. They couldn't recover from them, lost the liquidity. That was the famous, about 10 years back, that was the very famous Asian financial flu. That's what happened. So the collateral is very important. Each type of credit facility and the collateral accepted to that institution for such credit facilities and the procedure to be followed in each category are included in the credit policy. Yes, what type of collateral for what type of credit facility, to matching the credit facility with the collateral, and the procedures to be followed is there in the credit policy document. Apart from that, purpose of granting short-term and term loans mean medium and long-term. So short-term, medium-term, and long-term are also explained. Purpose of granting short-term, medium-term, long-term grant are also explained to safeguard the lender's interest and to ensure enforceability of collateral in case of default, also mentioned in the credit policy document. Collateral and documentation. Continue. How to obtain various types of securities. or collaterals for credit facilities are included in the credit policy document. So there are various types of securities or collateral, cash deposit, government securities, treasury bill and treasury bond, etc. Life insurance policies, shares in quoted or unquoted companies, stock in trade, that is, you keep the stock for trading purposes, that we call it stock in trade, movable, immovable assets, book debts, we will discuss later also, pledge facility, pledge, and guarantees and indemnities. So these are the securities or collateral. How to obtain this type of securities or collateral? That also they are in the credit policy document. Procedures to be followed for proper registration of mortgage bonds. Mortgage bonds or then trust receipt document or assignments should be registered in the land registry. So procedures to be followed for proper registration of mortgage bond, trust receipt, TR document, that is trust receipt document, and assignments are also included. All other documents needed such as letter of offer, agreements, bonds are also indicated with legal requirement. They are in the credit policy. So these are the things, of course, in the following lectures, various lecturers is explained to you. These are actually from your credit policy document. These are from the credit, you are already mentioned in the credit policy document. What are the collateral, different type of collateral, how to obtain, all the details are there. But anyway, our lecturers will be explaining these things. So you must also, you go through your credit policy document of your credit institution, bank or finance company. You must. Then the credit monitoring and follow, very, very important, which most of our people are neglecting. Credit monitoring and follow, very, very important. Procedures for credit monitoring and follow-up are included in the document. In the credit policy document is also there. Procedure, how to monitor and how to follow. Periodical reviews of credit facilities you have to do periodically. This is central bank instruction also. Periodical review of credit facilities. And then necessity for customers visit. You have to visit customers. When and where customers visit. Obtaining periodic report from customers. You must obtain periodic report from customers. In case if you are visiting, you are not visiting, you must get the reports. How to identify deterioration of credit are also included in the credit policy document. Downgrading of customers rating and the recovery procedures also outlined in the document. Actually, the customers rating we will learn later. Internal customer rating, bank has to do, rate their customers. The credit worthiness you have to rate. So you will, after rating, you will give some alphabetic or alphanumeric notation, AA plus or A1 or like that notation. You rate your customers, give some note, right? So periodical review of credit facilities, necessity for credit, that of course we are, downgrading of customer rating. So one customer based earlier rating, he may be AA plus, but now it is come down, maybe AA minus, downgrading the customer rating. And then recovery procedures. If the customer is not paying, what is the recovery procedures? Also outlined in the credit policy document. How to follow the recovery procedure. If the credit facility is to be restructured, procedure to be followed, as well as the delegated authority for such action also included. So restructures. Now the customer is defaulted. So you are restructuring, maybe rescheduling and restructuring. So how to do the restructuring? So this also will be you learn here in this program later. But it is there in your credit policy document. If the credit facilities to be restructured, procedures should be followed, as well as the delegated authorities for such action also who can approve, who has the dedicated authority to approve this restructuring. Is also there. If an NPA to be rescheduled with a capital or interest waiver, so sometimes the customer, of course, maybe due to genuine reason, he couldn't repay the loan. So, but sometimes the bank may be willing to waive off certain amount, maybe the interest, but very rarely the capital amount. So, if the NPA to be rescheduled with a capital or interest waiver, the maximum amount or concession that can be allowed under each authority level and the procedure included. So, what is the maximum amount? Who has the authority? That also there in the credit policy document. The persons responsible for the maintaining security document and the person's role in safeguarding the institution interest also included. Now the documentation, there will be a person who is maintaining the document, credit document, security document. The person is responsible. So the person responsible for maintaining the security document and the person's role in safeguarding the institution interest also included in the credit policy document. Then the NPAs, non-performing advances. Procedures to identify NPAs and the action to be taken thereafter and the accounting procedures are included. Actually, it is central bank instructions are there in regard to NPAs, different categorizing the different type of NPAs. You will learn later. So procedures to identify NPAs and the action to be taken thereafter and the accounting procedures are included in the credit policy document. Provisioning policy again NPAs, considering the period of credit facility was in default, also included subject to regulatory requirement, that is the central bank instruction. Based on that one, provisioning, how to provisioning, impairment loss, these are the things of course you will learn later, but these things also they are in the credit policy document. Based on prevailing legal requirement, the procedure to be followed in instituting legal action against each collateral also explained. How to institute legal action against the security, that is collateral, in case of defaulted facility. How to file legal action against clean and unsecured facility. What is clean and unsecured? That is without any security you have granted the facility. That is clean facility. And without any properties you have granted facility. Unsecured facility. Maybe a guarantors may be there, but that is unsecured facility. Without you are granted without any property, without taking any properties, mortgages. So how to fill legal action against clean or unsecured facility and secured facilities and the responsibilities of the relevant department and units explained in the credit policy document. Procedures and approval required for parate action, you will learn later about the parate action. Maybe some of you may would have heard about parate, but don't worry. There are some lecturers, they will be discussing about this parate action later. And after auction also explained in the document how to do this parate action, and the auction, all these information are given in the credit policy document. If a new facility is to be granted to a defaulted customer to revive the business, the procedures to be followed also included. So in the case of genuine customer but defaulted, non-willful defaulter. So there are defaulted customers. There are 3 categories. Please make a note of it. It is not there in the notes. One is non-willful defaulter. He has defaulted the facility obtained, but due to certain reasons cannot be prevented. Maybe the natural calamities or like that one he would have affected and he couldn't pay. But he is genuine. For the genuine reason he couldn't repay. Non-willful defaulter. Then other category, the defaulter, he has the means. He has done the business in a good way he has done. He has the money to repay. He has a repayment capacity. But willfully he is not paying. Mama monotada mega gavandone. Willful defaulters. One will defaulters, other one is willful defaulters. But there is another category, criminal defaulters. They are trying to take the bank loan for the purpose of defaulters. I have seen. There are type of, by using various influencers here and there, by using influencers from various quarters, they are trying to take the loan for the purpose of defaulting, not to repay. Criminal defaulters. So, non-willful defaulters, willful defaulters, there are criminal defaulters. Then, for procedures and approval required for parate action. So, what is the procedure you have to follow? So, from where you have to get the approval for the parate, and after auction, also explained in the document. If new facilities to be granted to a defaulted customer to revive the business, a non-willful defaulter, the procedure to be followed also included. That's also included in the credit policy document. Then another important thing, credit audit. So in all banks, they have the audit department. Periodically, they visit the branches, do the auditing, and submit the reports. And the report will be sent to the branch concerned. And for the question, the branch managers have to answer. If there are anything, of course, here they have to make the corrective measures. There is a separate chapter in the document for credit audit, outlining credit audit requirement and its aim. It is required to ensure compliance with the credit policy and the regulatory requirement, central bank requirement. So credit policy and the regulatory central bank requirement. Quality of credit granted, follow-up and supervision, skill level of credit personnel, and training need are the scope of the credit. So the credit audit, they will do the credit audit and submit their report. They are, of course, they will mention about quality of credit granted, about the follow-up and supervision, and skill level of the credit personnel. And if their credit audit team found the person is not very competitive, not very knowledgeable, then they may recommend training needs of those people who are handling the credit function. They recommend for such and such people who are doing this credit function in this branch, the training need in what areas. So these are things in the credit audit. Annual review of credit granted is an accepted policy of financial institution, and the audit team verifies adherence to the requirement. So annual review, annually all the credit granted by the branches, so they have to review. The branch themselves, the credit officer, the manager, they have to review. And credit audit will look at whether they have done it. Annual review of credit granted is an accepted policy of financial institution, and the audit team verifies whether it is adhered to this requirement. Then the credit risk management. So there is a separate lecture later, risk management. So credit risk is one aspect. There are so many risks. The lending institution, they are facing so many risks. Some of the risks, last lecture we have seen, interest rate risk, then maturity risk, foreign exchange risk, credit risk. We have seen these 4 risks in my previous lectures. Apart from that, legal risk, there is reputation risk. There are so many risks the lending institutions are facing. So there will be a separate lecture on the risk management by the credit institution later. Anyway, credit risk management procedure of the lending institution is an important part of the credit policy document. So how to manage the credit risk. Credit risk management procedure also mentioned in the credit policy document. It is a duty of the risk management team to ensure that the bank maintain diversified and quality loan portfolio to the bank. So the aim of the credit risk management to ensure that the bank maintain diversified, balance, various sectors and quality loan portfolio to the bank. Accordingly, the duties and responsibilities of the risk management department. All banks have their risk management department. So, accordingly, the duties and responsibilities of the risk management department in controlling the credit risk of institution are included in the policy. Okay, so these are the main things. These are the main things in the credit policy document. So all these things are discussed in our credit diploma in credit management program. So I have mentioned about this credit policy document, outline what and what things are there in the credit policy document. So you must please go through your own credit policy document, your bank credit policy document, and various circulars, periodical circulars, amended those what they have mentioned earlier. So thereby you know, so what is happening in regard to credit management in your institution. But in this program, all these aspects will be included in the following lectures. So you can enhance your knowledge. But these are there in the credit policy document. Okay, a word of advice to you all. All officers involved in lending operation within an institution must thoroughly review the credit policy document approved by the board of directors of the institution and understand all the guidelines comprehensively and be familiar with this document. So our program will help you, diploma program will help you to enhance your knowledge. Ignorance of the credit policy is detrimental to the organization, obviously, you know. Without knowing the credit policy of your institution, how can you grant credit facility? Ignorance of the credit policy is detrimental to the organization, as any deviation can result in serious violation of the law of the country or regulation issued by the regulator, Central Bank of Sri Lanka. So besides, the lending institution will be unable to recover credit facilities due to the negligence of the creditor. The negligence in the banks is a very negligence in the bank is very bad thing. Yes, negligence in the bank. It will be dealt with disciplinary action. Negligence. Disciplinary action. So, besides, the lending institution will be unable to recover credit facilities due to negligence of the credit officers as a result of violating the credit policy. Keep it in your mind. So negligence is a very serious, punishable offense. Punishable offense. Negligence is a very serious, punishable offense by a credit institution. Negligence. Right. So this is about the credit policy and the credit policy document in regard to the credit function of an institution. So if you all know, the people who are handling the credit knows their credit policy, as when I mentioned about, and your values, then your organization will have a strong culture, will have a strong credit culture. That's what the Basel also expect. That's what the Central Bank of Sri Lanka also expect. And that's what your credit institution bank also expect. All the officers handling this credit function should know the values of the organization and the credit policy of your organization. Okay. Now the time is 10:50. Let us meet by about 11:05. We go for a short break. Let us meet by 11:05. 15 minutes break. Thank you. Mr. Ranasinghe, you have a question? Yeah, Mr. Ranasinghe, do you have any question?
Yes, sir. Hello.
Yeah, yes, I am listening.
Sir, I couldn't participate last week lecture. Can I get the notes, sir?
Sorry, what is it?
Hello.
Yeah.
Sir, I couldn't participate last week lecture.
Yes.
How can I get the notes, sir?
Yeah, will you? Yeah. Okay, fine. Will you please contact Mr. Menaga? You know, you have Mr. Menaga's contact number?
Yes, sir. Yes, I have.
Please. I also will tell
Okay.
him.
Huh?
Okay. I also will
Okay,
tell
sir.
him. You speak to him, huh? He can give.
Okay, sir. Thank you.
Okay. Is it clear? Now we move on to the next subject in the credit management. Importance of risk management in credit proposals and mitigation. I have told you before this break about the risk. The credit institutions are facing various risks. Credit institutions are facing various risks. Mainly the credit risk, and then interest rate risk, maturity risk, foreign exchange risk, and legal risk, reputation risk, so many risks. So there will be a department in all the bank. There is risk management. There is a risk management team. So in our program also there will be a separate lecture about the risk management, various risk management. But the credit risk is an important thing. So now here, actually the credit risk start from the credit appraisal or the credit proposal evaluation. There itself the credit risk is started. So that's what importance of risk assessment in the credit proposals. That's what I am going to discuss. And the mitigation of this risk. That's what I am going to discuss. Mitigation. So all senior bankers used to say when they are assessing and granting the credit facilities, a well appraised credit proposal is half repaid. A well appraised or evaluated credit proposal is half repaid. So if you have done the appraisal or the evaluation of the credit proposal thoroughly and carefully, you can be sure it is half repaid. Balance half recovery, only your action, your follow-up and other thing, the balance half. So when you are doing it, the 100% recovery you can ensure. So you must, the credit risk is starting from the credit proposal itself. So that's what we are going to discuss. Importance of risk assessment in credit proposal and mitigation. How you can mitigate, how you can reduce it. Sorry, there's a yes. Now the risk. What do you mean by risk? Any activity in our life involves risks. While walking, I'm unexpectedly. is a risk. Any activity in our life involves risk. Risks do not disappear. Risk will be there. But only thing they give, the risk gave users a choice. Which to retain and which to shed. What risk you want to face, what risk you want to avoid and go. No risk, no gain. So when you face, if you are successful, there will be a gain. No risk, no gain. So almost all achievers in the world, they have faced the risk. And thereby they achieve their success. So no risk, no gain. This is the basic meaning of risk. General definition of risk. The probability of unexpected happening. Because of that one, the probability of suffering a loss. Unexpected happening. Probability of unexpected happening is a risk. Risk. The probability of, so you are facing a loss. So it is a measure of the probability of that risk, probability of that risk. And because of that one, what is the consequence of not achieving a defined goal? Some of you may be, yes. Some of you, or maybe most of you, following this program, Diploma in Credit Management, once you get success and you go through this exam, you will have a diploma qualification. With that one, your bank, of course, you may get a promotion. If you are a very young person, yes, after the promotion, you can get married and have a very, very interesting life. Yeah. So that is your balaprattu, that you are. But by chance, if you don't study, if you don't follow the lectures, don't follow the lectures carefully, then if you fail, what happened? Probability of unexpected happening. So that is that one. And because of that one, what you planned, you couldn't do it. You won't achieve your promotion and more salary and maybe getting married. So this is a measure of the probability of that risk and consequence of not achieving the defined goal. So this is a combination of probability and the consequence. It's a probability. That is the risk. So the risk is rare one, unexpected one, or unexpected one. Then I, outcome, incident, unexpected incident, or unexpected outcome. So what you have to do is selection. You must identify. This is the risk. This is the risk I have to face. So identify. Then K, knocking that risk. Knocking. How? Measure the risk, monitor the risk, and controlling the risk. This is the risk. So in the case of risk, it is an unexpected outcome. So what you have to do, you have to identify the risk, measure it, monitor it, and control it by various means. You control it. So this is the thing. So in the credit risk also, this is what we have to do. It is going to default of credit facility. Is a particular customer. We think he will repay, but if he default, then yeah, unexpected outcome. So what you have to do, you must identify, yeah, he may default. Then you measure it and monitor it and control by various means. So this is the credit risk, basic thing in the credit risk. Risk involves two concepts. One is the likelihood that some problematical event will occur. Something may occur. Unexpected problematic event may occur. If it occurs, the impact of the event, if it does occur. So if it occurs, what is the impact? So the risk is a joint function of two things. joint function of two things. One is risk is the function of likelihood of that risk occur, and if it occurs, the impact, both jointly causing the risk. Hence, risk should be assessed qualitatively and quantitatively. Whether it occur, if it occur, what will happen, what will consequent quantitatively. So qualitatively and quantitatively, you have to assess the risk. Other elements of the risk. One is cause of the risk. So there is a risk. There may be causes, various causes for the various things can cause the risk. The risk. We call it risk factors. We call it risk factors. Please keep this word in the mind. Cause of the risk. Risk factors which can cause the risk. Then there's another thing also. Something or lack of something can induce a risky situation. So something there can cause a risk. That is risk factor. There is another term, hazard. Source of the danger, hazard. So if there are any measures to prevent the hazard or the risk factors preventing the hazard or the risk factors, those are safeguards. So the risk is again the function of hazard or the risk factors which causing the risk, or the hazard causing the risk, and the safeguard which prevent the risk. So the hazard and safeguard, two important things. Now, the motorcyclists are advised to wear the helmet. While riding, if there is an accident, actually the brain is the most delicate organ in a body. If there is any accident, that will get affected very badly. So at least to prevent that one, we wear the helmet. So the risk is accident, damage in the head brain. That is the hazard, source of the risk. And the helmet is the safeguard. We are wearing safeguard helmet to prevent the hazard of damaging the brain. Risk factor damaging the brain. There are various risk factors. So one is hazard, another one is safeguard. While driving a car, you are supposed to wear the seat belt. Why? There may be a hazard of accident. So the seat belt is preventing your body, chest, the heart is getting affected. Preventing. Safeguard. So the hazard and the safeguard. So the hazards are there, risk factors are there, and we are making safeguards. So this hazard or risk factors, they are everywhere. Everywhere. Not only in banking, even the medicine. Heart attack is a risk factor. There is a risk, heart attack. Consequent, the patient may die. Heart attack. That is a risk. Consequent, the patient may die. The risk factors, there are various risk factors, doctor says, which can cause the risk of heart attack, overweight, smoking, unresponsible drinking, lack of exercise, family hereditary. These are the risk factors which can cause heart attack. The consequence will be death. So there are, doctors say, there are safeguards to prevent the heart attack. Do exercise regularly. Walking is a good exercise. Eat responsibly. Don't eat oily food, etc. Then do not smoke. That is very bad. If you are drinking, drink responsibly. These are safeguards to prevent heart attack. So now you may understand the risk factors or the hazards which are causing the risk, and the safeguards which prevent the risk factors which causing the risk. Now, in the petrol station, when you go, you can see a notice. First one, do not smoke. Stop engine. Do not use mobile phone. These are risk factors. What are risk factors? Smoking is a risk factor in the petrol station because by chance it may get fire. The petrol station may get fire. It may affect so many people. Some people may die also. So risk factor. So prevent that one. The board is there. Do not smoke. Engine. Stop the engine. The heat is coming from the engine. If it is working. Then there is in the petrol station, there are petrol vapor that can get ignite immediately. If the environment is heated, the petrol vapor will get affected. So the engine heat, if the engine is working, engine heat is a risk factor. To prevent that one, the notice board says, stop the engine. Mobile phone. Sometimes the mobile phone battery is getting heated. Sometimes it bursts also. So in the petroleum vapor can easily get fire. So prevent that one. The safeguard. These are the safeguard. Do not use mobile phone. So now you understand the risk factors which causing the risk of various risks. And the other one, that is safeguards. So now we go through these other elements of risk. Causes of the risk factors. Something or lack of something can induce a risky situation. That is source of danger or risk factor which can causing the. Then the thing is preventing or reducing the danger, reducing the risk factor, reducing the hazard, safeguard. So risk is the function of hazard and safeguard. So the good risk management should identify hazard, good risk management, especially in the case of credit management. So you must identify the hazards and allow safeguards to be developed to overcome them. So in the credit proposal, you must identify what are the hazards. While doing the evaluation, you must see what are the risk factors which can cause the risk of default. What are the hazards which can cause the risk of default? And what are the safeguards we can provide to reduce the risk of defaults? So good risk management should identify hazard and to allow safeguard to be developed to overcome them. If there are enough safeguards, risk can be reduced to acceptable limits. So that depends on the evaluating appraisal officer. He must, while doing the appraisal, what are the risks which can cause, what are the hazard which can cause the risk of default, and how can I prevent, what are the safeguards I can provide to reduce the risk of default, that is the hazards and the risk factors. A good example, I generally say, malukam, fish curry or fried fish, malukam. The fish is a very tasty food. But only thing there are cut. The bones are there. Fish bone. Some fish have many food, but the fish is so tasty, but it has the cut. It has the bones. So if a person, if they think, Mama, me malu kayama kayavot, me kagila, ukure me hiravela tibunanang kato, then big problem. I have to go to hospital. They have to surgically remove it like that. So I don't want to eat. I don't want to eat fish. He won't have a good meal, right? We won't have a good fish meal. He won't have. But if a person, yes, I have to be very careful. I must remove this bone carefully. I will say remove the way and eat the fish. Then he will have a good fish kama. Fish kama he can have. So it depends. Here the risk of bone, fish bone. It may get entangled in your throat. Then you have to go to the, consequent, go to the hospital, surgically, sometimes surgically, you have to remove it. But if the person is very careful to removing those bones and then eat, he will have a good meal. So in the case of bank also, if you think risk, credit risk, the customers may default. Customers, so better not to grant the loan. Can you do it? The main function of the credit institution, bank, granting loan, deposit mobilization and granting the loans. You have to. If you don't grant the loan, then what will happen? You don't have the business. Your profit will go down. Just keeping the deposits only. What you are going to do? But some managers are like that. They are fear. They are fearing of the default. Because of that, they limit. They don't give loans. That is very bad. So what you have to do? You have to analyze and see what are the risks. What are the risk factors? What are the hazards in this credit proposal? How can I reduce these risk factors? How can I reduce these hazards? And then grant the facility. By that way, providing safeguards. By that way, I will get the 100% recovery. So that should be the way. So when you do the analysis, the risk, overall risk function of its component, there is probability of loss, there may be high, then it may be low. Then impact, if it happens, what is the impact? One is low or maybe no impact, maybe large impact. If the probability of default is high and the impact also large, then it will be here, it will be there, and great risk, high risk. Probability of risk is low and the impact also low, then it is very, very low risk. Consequence also very low. So by analyzing this, you can have three types of risk. One is low risk, and then moderate risk, and the high risk. High risk, of course, suppose, I think you won't be able to provide any safeguard. In that case, you decline the facility. Moderate risk, yes. Can you safeguard, provide safeguard to reduce the risk? Then consider the moderate. And the low risk, yes. Can you provide safeguards? Yeah. In that case, consider the low risk proposal. So the low risk credit proposal, moderate risk credit proposal, high risk credit proposal. The low risk credit proposal and moderate risk credit proposal by providing suitable safeguards. By providing suitable safeguard, you can reduce those risk factors and the hazard, and you can consider the credit facility, and you can get a good recovery also. This you should know. So that is by way of analyzing, appraising, evaluating the credit proposal very carefully. That's what we call analyzing the credit proposal, the risk. So this risk starts from the credit proposal itself. So well-appraised loan or well-evaluated credit facility is half repaid. That's what our senior banker said. Right. So by keeping in this mind, we go creditworthiness and the credit risk, there is a relationship. If you take the credit risk, if the credit risk is low, then creditworthiness is high. If the credit risk is high, then the creditworthiness is low. So creditworthiness and the credit risk, there is a relationship. When the credit risk is low, creditworthiness is high. When the credit risk is high, creditworthiness is low. So that means credit analysis, really risk analysis, credit risk analysis. When you are doing the, keep it in your mind, when you are doing the analysis, evaluation of credit proposal, it is really credit risk analysis. Management of credit risk. So how? You had to provide the safeguards. Management of credit risk in the credit proposal. So when you provide safeguards in the credit proposal to reduce the credit risk, then first is assessment of credit risk. You assess while going through the credit proposal, assess. That is, identify what are the hazards, what are the risk factors which lead to default, credit default. Identify by assessment of credit risk, assessing. Identify by doing the credit proposal. Identify the hazard. And then you provide, say, suitable safeguards. You think about suitable safeguards to prevent these hazards, so the risk factors. Then mitigation of or reduction of credit risk. First, of course, assessment, identify and plan your safeguards. Then mitigation, that is reduction of credit risk. How can you reduce? Reducing the hazard by increasing the safeguards. So what are the hazard risk factors? How can I reduce those risk factors or hazard by providing suitable safeguards? So maybe some organization have come to you for a credit facility, some business organization, everything is okay, you are satisfied, but unfortunately the production department is weak. Maybe in that organization, production, that is the hazard, that is the risk factor. If the production department is weak, they won't produce the expected quantity or quality of production, then they won't be able to market. Then that is a hazard. You have to prevent that hazard. You have to provide a suitable safeguard. Then you have to tell the management, this production department is weak. For these reasons, this production department is weak. So you have to improve the production department. How can we improve? Get their suggestion. You put your suggestion also. So I put it as a condition, safeguard. Put it as a condition, safeguard. So you have identified the hazard or the risk factor. Now you are providing a safeguard with the consent of the manager. So they may employ a good production manager with good salary, good experience and everything. Yes. Similarly, everything is good, but the financial management is bad. That is done by the company owner themselves. They are not qualified. So you find out financial management is bad. Look here, you are telling the company owners, look here, everything is okay, but your financial management is bad. You have to improve it. You have to correct it. How can we correct? Bring some capable, experienced, qualified accountant, financial manager, maybe at a higher salary. Safeguards. So by that way, you mitigate the risk by providing suitable. So this will come as the condition. This will come as the condition for the credit facility. So you come as the condition. Apart from that, you say, maybe you are at the head office. This loan is required by some branch in a province. So this proposal has come to you, head office. Maybe some limit may be over 5 million or 10 million. It has come to you. So you have identified. Then you are putting all these conditions that will come in the credit proposal. Apart from that, you are telling a bank manager or the credit officer periodically visit. What period? Maybe once in 2 months should be visited. They should visit the factory and submit the report. Together with the financial report, a comprehensive report should be submitted to the head office. This is for the branch. So they have to visit. So it is follow-up and monitoring. Follow-up and monitoring. So these are mitigation strategies or reduction of credit risk strategies. Reducing the hazard, increasing the safeguard. In addition, cushioning the risk through collateral. So in addition, you obtain a suitable collateral to cushion this risk. In addition, you obtain a suitable collateral to cushion the risk. If it is a long-term facility, get a long-term collateral, property meaning okay. If it is a medium-term loan, obtain a medium-term property, medium-term, maybe a property or a machinery, like that, medium-term collateral, like that. So now it is coming. Controlling and monitoring of credit risk. So now first, of course, assessment of the credit risk. Then how you are going to reduce or mitigate the credit risk. And now controlling and monitoring the credit risk. Follow up and supervision. Follow up and supervision. So that is pre-sanction and post-sanction. Sanction means approving the credit facility. Pre-sanction means before approving the credit facility, pre-sanction. Post-sanction means after approving the credit facility. Both supervision you have to do it. Pre-sanction and by pre-sanction, you know what are the things. Then only you know what are the risk factors, what are the hazards. After sanction, go and see what are the hazards, what are the factors, no use. So before that, you must go and see what are the hazards for this proposal. What are the risk factors for this proposal which cause credit default? So follow up and supervision, pre and post sanction supervision. So if you are in the head office and the facilities in the province, then it should be in the credit proposal as conditions. That may come in the letter of offer. While granting the facility, there will be a letter of offer. So in the letter of offer, these conditions should be mentioned. You will learn these things later. The letter of what are the security documentation. Documentation. So follow up and supervision, pre-sanction. Then calling reports, monitoring, calling. If it is close by, you yourself can go and inspect, monitor. Or if it is in the province, you are in the head office, you can call for reports. Then attending meeting, you may, or the provincial managers, branch managers, credit officers may attend the board meetings. So that is a condition. So what is happening in the board meeting? They will discuss. Or special meetings. And the inspections. So these are the things. So these are in the credit branch level. Controlling and monitoring the credit risk. And then management of credit portfolio, that is overall limit. Maybe at the district level, maybe at the provincial level, maybe at the national level, management of credit portfolio, whether the NPAs are increasing or NPAs are reducing. Different type of NPAs as per the central bank directive. Yeah, what is happening? So this is at the national level. You have to monitor. So this is the management of credit risk. So basically, you must know what are the credit risk factors or the hazard which can lead to credit risk. That is default risk, credit default risk. So how can you prevent that? So mitigation and reduction and controlling and monitoring. Management of credit risk. Okay. So these are the general things we have discussed today. And now we move on to another important aspect. Types of credit facilities and advances. Banks are granting various types of credit facilities. So now we are going to discuss one by one basic information. Basic information we are going to discuss. Types of credit facilities or advances. We call it credit facilities or advances. Bank advances, we use the term. So there are two types of credit facilities, basically. Credit facilities or advances. One is direct advances or facilities. Other one is indirect advances. What is direct advances? It is fund-based. That is, from the bank, the fund or the cash is going to the customer by way of credit facility. We call it fund-based. The fund is actually, when the facility is granted, fund is granted to the customer. The fund is cash is going to the customer, the loan or overdraft or whatever it is. Fund-based. Since the fund is going there, bank is charging the interest income. So the direct facilities are fund-based. You understand the meaning of fund-based. fund is going from the bank to the customer. Since the fund is going, bank is charging an interest, lending interest, charging interest income. So these things are coming in the bank balance sheet, shown in the balance sheet as advances or facilities. Direct advances or facilities is a balance sheet item as bank assets. As balance assets, there is this asset differ from the other asset, so we call it risk-weighted, risky assets. Risky asset, because asset, if it is default, so risky asset. What is this? In between, something is coming and going, right? So this is a balance sheet item. It is an asset. What you are granting as loans, as advances, credit facilities, is shown in the balance sheet as assets. So, but it differs from the other assets, so we call it risky assets, risk-weighted assets. Okay. Since the fund is going from the bank to the customer, there is another aspect. It affects the liquidity, the cash position of the bank, or the cash flow will be affected by fund is going out from the bank to the customer. So these credit advances, direct advances or facilities, when we are granting, at the time of granting, it affects the bank liquidity or the cash flow of the lending institution when the facility is granted. I hope this is clear. It's a basic thing. On the other hand, indirect advances or facilities. What are these indirect advances or facilities? Non-fund based. First one is fund based, this one is non-fund based. The fund is not going to the customer, but the facility is granted by the bank. Facility is granted, but the fund is not going to the customer. Since the fund is not going to the customer, cash is not going to the customer, bank can't charge interest. So not the interest income. But the bank can charge a fee, a commission, or charge, bank can charge a fee. So we call it fee-based income. Non-fund based, and it is income is fee-based. There in the fund-based, that is interest income. Here non-fund based, fund is not going to the customer from the bank, so it is fee-based income. A fee is charged. Since the fund is not going, you can't mention in the balance sheet. So we call it off-balance sheet item. This is off-balance sheet item. In the balance sheet, it is not mentioned. But as a note, it will be mentioned the total fund-based indirect advances, this much, as at this date, this is the total indirect advances. As a note, it will be mentioned. That is indirect advances or facilities. Non-fund based, then it is fee-based income, off-balance sheet item. We call it contingent liability. So, at the time of granting the facility, it is not a liability to the bank. It is not a liability to the bank. But if there is a default of this facility, that is indirect advances, we will learn. Yeah. If there, then it will become as a liability to the bank. So we call it contingent. Then now it is not a liability, but it may become as a liability. So we call it contingent liability. Meaning of contingent liability means then maybe samara velawata make a liability venavam bank water off balance sheet item, that is contingent liability. Then since the fund is not going out of the bank, do not affect the liquidity. Since the fund is not going out of the bank, it won't affect the cash flow of the lending institution when the facility is granted. So when the non-fund based indirect advances are granted, the bank liquidity or cash flow is not affected at the time of granting the facility. Maybe later it can, maybe later it can. But at the time of granting, it is not affecting the bank liquidity or the cash flow of the lending institutes. So there are two types of credit facilities. One is direct advances, and basically direct advances or facilities. Other one is indirect advances or facilities. Now, direct advances. Direct advances. Examples, loans. So when you grant the loan, fund is going from the bank to the customer. Bank is charging the interest, lending interest charging. Similarly, overdrafts, ODs. When the OD facility is granted, fund is going from the bank to the customer. Bank is charging interest. Then bank, and this also I have explained last lecture, line of credit. So when the bank is granting a line of credit to the customer, when the customer withdraw the money, fund is moving from the bank to the customer. And bank is charging interest. In these cases, bank liquidity will get affected, cash flow will get affected. In the cash credit. So in India, they use the term cash credit for the business customers, overdraft, something similar to the overdraft. In India, something similar to overdraft, they call it cash credit. That is the business customers. In the case of personal customers, they call it as overdraft. In the case of business customers, it is like overdraft, but they use the term cash credit. And then bill discounting. Bill discounting. One good example is check purchasing or check discounting. Check. Now, a person is giving a check, maybe People's Bank check, Nuvarelia Bank check. If he given maybe about 200,000 rupees, he has given me. No, I am just telling you, he didn't give me. I am just telling you, a 200,000 rupees check from Nuvarelia People's Bank check he has given to me. And then date is today's date. Today is 13th. Okay, yeah, today's date. Date is today's date. What I have to do is, maybe it is cross-check also, cross-check. So it has to go through the account. I have to put it to my account. And it may get tomorrow evening, it may get realized. If there are holidays, of course, sometime maybe after 2 or 3 days only, I will get the credit to my account. If there is no problem on the other side. But I need the cash very urgently. Then what I can do, I can go to my bank branch manager. Look here, I am having this 200,000 rupee check. Today is dated, but I have to deposit to the bank, my account, and only it will get realized. But I want the cash immediately for certain urgent purpose. Could you please purchase this check? If I am a good customer of the bank, then he will say, okay, I will purchase. So fill the check deposit slip and overly write highly purchase the check. So I will purchase. I will write, and as he said, I will give it to him. He will collect the check and he will send for realization. He will change the realization, clearing. And immediately he will credit. He will credit 200,000 rupees will be credited to my account. And he will charge a commission that is almost equal to the interest chargeable on that amount for those number of days. That's a commission. We call it commission, but that commission is almost equal to the interest chargeable for those amount of the check and for that period that will be recovered. So I will get the cash. We call it check purchasing. Check purchasing facility. This is also a type of bill discounting facility. But in the case of check purchasing, the check should be today's date. Then only the manager can purchase it. So I will send, if everything is okay, no problem, that fund from the Nurli account will come. So that will be cleared. If the check returned, then manager will ring up and look here, we have purchased your check, the check returned immediately, put the money. So I have to somehow or other collect the money and go and put it to my account to clear it out. So this is check purchasing. This is also a type of bill discounting. Then, if the check is post-dated, maybe 17 or 18 post-dated check. So then I can, yes, in the same position, I need the money immediately. I go to the manager. Look here, this check is 18 dated. I need this 200,000 immediately. Could you please help me? Okay, that if that bank is allowing this type of, this is calling check discounting. That facility is called as check discounting. If it is a post-dated check, that is check discounting. If it is the same date, say same date, it is a check purchasing. This is the difference. Okay. Then the manager will ask me to prepare the check deposit slip and ask me to write discount it. Then I will do that way and give it to manager. Will give me the immediate amount and charge the commission, which is almost equal to the interest chargeable on that 200,000 for those number of days. For those number of days, I will charge. Then he will pay me the 200,000 and then he charges commission. I can take the money and use it for my purpose. If the check is honored, then no problem. If the check got returned, then what will happen? Manager will phone me. I have to immediately collect the money and put it and settle it. So this is bill discounting and bill purchasing. So check is a bill, then check purchasing I have told you as an example. Here this is purchasing as well as discounting. Then in the international trade also, bill purchasing and bill discounting is there. Bill we will be discussing later. We will be discussing it later. So this is bill discounting, bill purchasing. So the fund is moving from the bank to the customer. So this is also direct advance, direct advance. Then another category, revolving credit. The revolving credit facility is also there, but in the case of credit cards, it is revolving credit. Bank has given us a credit facility, we are utilizing it, and then we put the money, and again here we utilize it. Bank will charge the interest from the credit card account. So that is also revolving credit. Also, example credit card, the bank is granting the facility. Fund is moving from the bank to the customer. In all these cases, different type of loans, different type of ODs, overdrafts, and it may be line of credit or cash credit. In bill discounting, bill purchasing, revolving credit, credit card, the fund is moving from bank to the customer. So these are direct advances. These are direct advances. Loans. Now we look at loans, the basic features of loan. Granted on application after careful credit evaluation. So customer has to make an application and the bank has to do a credit evaluation, careful credit evaluation, and then facility is granted. That is loan. In the case of loan, there is a loan limit. So what is the maximum amount of loan that we call it? Loan limit. Limit application, we call it limit. So maybe it may be 10,000 rupees limit, or it may be 100,000 limit, or 1 million rupees limit, or 10 million rupees limit, even 100 rupees million limit, depend on the customer. And then for the loan, there are terms and conditions. Terms and conditions, and there will be covenants also. Covenants also, condition. Terms and conditions. Yeah. Then terms and conditions. What is a repayment period? Whether there is a grace period. Whether what are the securities? What is the interest rate? All these terms, and we call it terms and conditions for the loan. On what terms and conditions we are granting the facility. That is, for the loans, we have terms and conditions. And generally secured. The loans are generally secured. That is collateral. You obtain the collateral. Generally, loans are granted based on the collateral. That is their loan. Then there is a definite reduction program. Then there is a definite reduction program. That is repayment program for the loan. That is a definite, if it is 36 months, 36 installment or whatever it is, based on that, then monthly the customer has to pay. So definite reduction program. And we call it repayment program. Or sometimes we call it loan amortization. That also internationally, big organizations use this term, loan amortization. When international funding agencies granting loans to the government of Sri Lanka, they call it loan amortization. So generally, since installment is repayment by way of installment, there is another term, installment credit also for the loans. So these are the basic features of loan. Installment credit, basic features. Then the other one, other direct advance, what we have seen before, overdrafts. Overdrafts. Overdraft means overdrawing. So these overdrafts are mainly two types. That is permanent overdraft and the temporary overdraft. These overdrafts are allowed in current account. So current account, what are the banks who are maintaining current account? Commercial bank. So this facility is given by the commercial banks to their customers, current account holders, permanent or temporary overdrafts allowed in current account by the commercial bank. So this is also granted on application after careful evaluation. So overdrafts also, whether it is temporary or permanent, on application, customer has to make an application and the bank has to evaluate carefully whether this customer is eligible, suitable to receive a overdraft facility and then granted. There is an OD limit. There are, of course, loan limit. There is an OD limit. When the loan OD is granted, there will be an OD limit. Maybe 25,000 OD limit, 50,000 OD limit, or 100,000, 1 million, 10 million OD limit. That means within that limit, customer can withdraw. Within that limit, customer can withdraw. And then when the money comes, customer can deposit. So the balance, overdraft balance, may get reduced in the current account. Now, for an example, 1 million rupees overdraft is allowed. So the customer withdraw. So it has come up to 1 million. The India limit has come. Then the customer comes and put 500,000. So the overdraft balance is coming to 500,000. So the customer can take another 500,000 withdraw. Another 500,000 he can withdraw up to 1 million. This is customer can do up to the loan overdraft period, up to the granted overdraft period. So OD limit is the maximum OD limit. This balance fluctuates within the limit. Depending on the customer putting the money to his account, the balance, OD balance, will fluctuate. When the customer puts the money to the account, the OD balance will get reduced. When the customer takes the money from his account, the OD balance will go up. So this is OD limit. Balance fluctuates within the limit. For the OD also, terms and conditions are there, covenants are there. What are the terms and conditions are there, covenants are there. Generally secured, so collateral. Mainly the permanent overdraft, it is generally secured. Temporary overdrafts are generally not secured. For the good customers, they may grant For the good customers, they know. So permanent overdraft are secured generally with collaterals. POD, permanent overdraft facility, generally to meet working capital requirement. For the business people, it is generally to meet the working capital requirement. Why working capital? You will learn later. It is revolving. Working capital is revolving. That is, when the customer purchases a working capital item, he will take the money. When he sells, when the money comes, account will be credited. So it is revolving. So for the working capital, generally, banks are granting, generally to meet the working capital requirement, the permanent overdraft facility. There are other type of facilities also granted to meet the working capital requirement. One way, a permanent overdraft facility. This is for the business customer. On the other hand, sometimes some customers who may have deposits, maybe 5 million or 2 million rupees deposit, they make a overdraft facility, permanent overdraft facility against that fixed deposit. So the bank will allow certain percentage based on the credit policy document which I mentioned today. Based on that one, or certain percentage of the fixed deposit amount can be allowed as a permanent overdraft facility. So that customer, whenever he needs, maybe to purchase certain item, household item, they may withdraw. They may withdraw. So the overdraft balance will go up. When they withdraw the money from the account, the overdraft balance will. When he get the money, they will put it. So the overdraft, when they deposit the money, the overdraft balance will come down. This is operating. So some personal customers also, by keeping their fixed deposit, they can obtain permanent overdraft facility. But generally for the business customers, to meet the working capital, it is generally permanent overdraft facilities given. So PODs, generally to meet working capital requirement, with or without definite repayment program. So when they give permanent overdraft facility, POD, to the business customers to meet their working capital, there are two types. Sometimes they may mention a repayment program. If this facility should be brought in during a 5-year period. So annually it will be reduced. And at the end of 5th year, it will be completely reduced. That is with a repayment program. POD with a repayment program. Some cases without any repayment program. So it will be allowed because why? They need working capital funding. So because of that one, permanent overdraft is allowed continuously. But in that case, it will be reviewed annually. It will be reviewed periodically, generally annually. And the review means whether they can allow this facility to continue based on various things. They analyze the account and the overdraft facility. They analyze and see whether they can allow this. So if there are a lot of check return, if there are balances without any deposits, yes. When there is no deposit, the interest will be accumulated. Monthly interest will be added to the balance. Overdraft balance, monthly interest will be added. So it will come up. Sometimes it exceeds the overdraft limit. If the overdraft limit is 5 million, by adding interest and interest, if the customer is not depositing money, it will go up. Sometimes it may go 6 million, exceeding that. When it is accumulated, we call it hardcore, H-A-R-D, hard, C-O-R-E, hardcore overdraft facility. That is non-operating interest is getting accumulated. Hardcore overdraft facility is not there. Please make a note in your papers. Hardcore. What is meaning of hardcore overdraft facility? So POD is generally to meet working capital requirements with or without definite repayment program. So sometimes it may be with a definite repayment program. Annually it will be reduced, and the repayment period will be completely wiped out. And then without, so it will be allowed. In that case, it will be reviewed. Meaning of review, the facility mean see whether this facility can be allowed to continue. by analyzing various things. The check return, the deposit, total withdrawal, everything. So this is review, periodic. Then TOD, short term. TOD means temporary overdraft, maximum 3 months. To be settled within a specified period. Maximum 3 months. So generally the bank won't take any collateral or security. So it is high risk advance. We call it high risk advance, generally considered for good customers of the bank. Then there is another overdraft, casual overdraft. The meaning, this term is there in the banking circle. Branches, they use the term casual overdraft. The meaning, I am having an account with the bank branch. I have issued a check, maybe 100,000 to a person, dated. I have forgotten. Then the check is cross-checked, so maybe through clearing, it has come to the bank branch. Manager see, oh, this man has issued a check for 100,000, no money is insufficient. What to do? Shall I return it, or what he will think? No, his customer is good. Then immediately he telephoned me. Look here, your check has come. There is insufficient fund. Then only I realized, oh my God, I have given the check. Oh, please, can you do something? Okay, I will pass it overdraft. I will pass the check today. You come and deposit the money tomorrow. He tell me and pass the check without returning. So he has given an overdraft. That overdraft is called casual overdraft. All other overdrafts, whether it is permanent overdraft or the temporary overdraft, those are requests. There will be written requests. I have mentioned granted on application. Granted on application after careful evaluation. This is based on the good customer relationship. The manager pass it. We call it casual overdraft. Bill discounting. I have already explained. Check purchasing or check discounting. I have already explained. Then bill discounting, bill financing. Financing post-sale operations. Financing post-sales operation. It is in the international trade. So generally, of course, if I explain to you now, it may be very difficult for you to understand. Once after doing the international division, I will explain this. International trade bills. Under letter of credit, under documentary collection also, there are bill discounting, bill financing is there, bill purchasing, bill discounting or financing is there. I will explain you this one later, bill discounting. And then there is inland bill also. I maybe discuss that one later. Anyway, now I think I want to stop with this one today's session. There are other things I'll be discussing in the next lecture tomorrow. Next lecture, another new subject also will be there. With that one, I am stopping it now because still maybe some people may be joining this program last time also. Now today, one person wanted the last lecture note, maybe because of that one. But from the next week onwards, I will be doing. So this time I have stopped here in case, because this is the type of credit facilities is very important today. What we are discussing today is very important for the people. Type of credit facility, mainly they don't know what are the things, what are the credit facility they can offer to their customers, under what circumstances, what purpose. So I'll be continue this one in my next lecture. If you have any questions, you can ask me now. Otherwise, you take down my phone number. When you go in through the notes or these lectures, if you have any doubt, you can telephone and ask me. 0777 0777, then 708, then 184. I will repeat it once again. 0777 708 184. Yeah, if you have any doubts, or certainly if anything is not clear, you can speak to me. Okay, if you have any questions now, you can ask me now. Viability oriented lending against security oriented lending. So when you are granting the facility, you must ensure that facility, the viability. That is, viability means whether the customer can generate sufficient funds by using this loan. He may do some venture project or business by using this money that we are granting. So there, whether he can make sufficient funds, sufficient cash flow to repay this loan. We call it viable venture, viability. So rather than looking for the collateral, security-oriented lending, that also important you must take. But primarily, when you are advancing, when you are granting, whether that project is viable, whether that business is viable, whether that venture is viable, you must ensure. So for that, of course, you have to do a very clear analysis. So you must be skillful to do that analysis. That's what we call it viability-oriented lending. So your lending should, after granting, the venture should be viable rather than security-oriented. Is it clear? Okay, right.